On January 1, 2026, China's Ministry of Commerce enacted a regulation that received minimal coverage in Western financial media but has already begun reshaping global commodity flows in ways most market participants are only now beginning to recognize. The regulation itself is straightforward. All silver exports from China now require a special 2-year government license. What makes this significant isn't the bureaucratic mechanism, it's the scale of what sits behind it. China doesn't just participate in the global silver market, it controls the refining, processing, and distribution networks that handle somewhere between 60 and 70% of the world's refined silver supply. And as of 3 weeks ago, all of that supply now moves only with explicit government approval. Welcome back, I'm Sun Park, and this is Rapid Report by Sun Park on this channel. We focus on breaking down global financial developments, institutional decisions, and macroeconomic signals that often go unnoticed beneath the headlines. Today's topic isn't about predictions or hype, it's about understanding the pressures quietly shaping markets right now. The immediate question most people ask when they hear about export controls is whether this represents a ban. It doesn't. China hasn't stopped silver exports. What it has done is something structurally more significant. It has converted what was previously a market-driven commodity flow into a discretionary policy tool. The difference matters because markets price certainty. When a commodity moves freely based on supply and demand dynamics, buyers and sellers can hedge, plan, and optimize around predictable incentives when that same commodity becomes subject to administrative approval. The pricing mechanism changes. It's no longer just about the metal, it's about the relationship between the buyer and the entity controlling the approval process. This shift didn't happen in isolation over the past 18 months. China has systematically expanded its export control framework across a range of strategic materials. Gallium and germanium controls were implemented in mid-2023. Graphite restrictions followed later that year. Rare earth processing limitations have been in place in various forms for over a decade. What distinguishes silver from these other materials is its dual nature. It's simultaneously an industrial input and a monetary metal. That dual functionality creates pressure points in places most export control frameworks don't typically reach, specifically in the financial derivative markets that have historically kept physical silver prices anchored to broader commodity trends. To understand why this administrative layer matters, you need to understand how global silver supply actually moves. China produces roughly a third of newly mined silver each year, but that's not where its dominance comes from. The real leverage exists in refining capacity. Silver doesn't come out of the ground in a form that's immediately usable for industrial applications or financial products. It has to be refined to specific purity standards, processed in 2 particular forms, and certified to meet exchange or manufacturing requirements. China has spent 2 decades building the infrastructure to do this at scale. The result is that even silver mined in Mexico, Peru, or Australia often moves through Chinese refineries before it reaches end users. When you add domestically mined supply to the throughput from foreign sources, you end up with a processing network that handles well over half of all refined silver flowing into global markets each year. Now consider what happens when that processing network becomes subject to discretionary licensing. Industrial buyers, the manufacturers producing solar panels, electronics, medical devices, automotive components, suddenly face a new variable in their supply planning. It's not enough to have a contract with a supplier. They now need to factor in whether that supplier can obtain the necessary export approval from Chinese authorities. This doesn't manifest as an immediate shortage. What it creates is something more subtle and more persistent: structural uncertainty in forward planning. Markets typically handle uncertainty through price. When future supply becomes less certain, forward prices rise to compensate buyers for that risk. But silver markets operate with a complexity that makes this adjustment mechanism less straightforward than it might appear. The vast majority of silver price discovery doesn't happen in physical markets, it happens in derivative markets, primarily on COMEX in New York and to a lesser extent on the London OTC market. These are paper markets where participants trade contracts representing future delivery of silver without necessarily having any intention of taking or making physical delivery. The pricing in these markets has historically stayed relatively close to physical market pricing because of arbitrage. If paper prices diverge too far from physical availability, arbitrageurs step in to profit from the difference, which brings prices back into alignment. That arbitrage mechanism depends on one critical assumption: that physical metal remains accessible enough for arbitrage to actually function. If you can't reliably source physical metal to deliver against a contract, or if doing so requires navigating an approval process with uncertain timelines, the arbitrage breaks down. This is where the licensing requirement starts to create pressure that goes beyond simple supply and demand. It introduces friction into the mechanism that keeps derivative pricing tethered to physical reality. We've already seen early evidence of this friction emerging in certain regional markets. Dubai and Tokyo have been most notable. Physical silver premiums over COMEX spot prices have widened significantly. There are reports of transactions occurring at premiums of 50 to 80% above the derivative market price. In some cases, physical metal has reportedly changed hands at levels approaching $130 per ounce, while COMEX quotes remained in the low 70s. These aren't momentary spikes driven by short-term squeezes. They're sustained divergences that have persisted for weeks, suggesting something more structural is occurring in the physical availability of metal relative to paper market expectations. This kind of price bifurcation typically emerges when there's a fundamental mismatch between where metal is and where it's needed, combined with barriers that prevent that mismatch from being quickly resolved. The Chinese export licensing requirement creates exactly this kind of barrier. Metal exists, it's sitting in Chinese refineries, in bonded warehouses, in processing facilities, but moving it across borders now requires satisfying a bureaucratic process whose timelines and approval criteria remain somewhat opaque to Western market participants. The immediate impact falls on industrial users, but the broader implications extend into financial markets in ways that are still unfolding. Silver occupies an unusual position in commodity markets because of its monetary history and continued role in investment portfolios. Central banks don't hold it the way they hold gold, but retail investors, family offices, and certain institutional players maintain silver positions as an inflation hedge, a portfolio diversifier, or a speculation on monetary instability. These holders have historically been able to rely on liquid markets with tight bid-ask spreads and ready convertibility between physical and paper positions. As physical premiums widen and delivery timelines extend, that liquidity assumption starts to be tested. COMEX registered inventories, the portion of warehouse stocks available for delivery against contracts, have been declining for several years. But the rate of decline accelerated notably in late 2025. In early January of this year, registered inventories dropped by roughly 26% in a single week as traders opted for physical delivery rather than rolling contracts forward or settling in cash. That kind of drawdown rate is unusual. It suggests participants are becoming less confident in the fungibility between paper and physical positions, which in turn suggests their pricing in some probability that future access to physical metal may become more constrained. The incentive structure here matters. If you're an industrial buyer who needs physical silver for manufacturing and you're seeing delivery timelines extend while premiums widen in spot markets, the rational response is to secure supply earlier and hold more inventory than you might otherwise. That behavior is already visible in lease rate markets. Silver lease rates, the cost to borrow physical metal for a defined period, typically run between 30 and 50 basis points in normal market conditions. By January 2026, lease rates had risen to approximately 8%. That's not a momentary spike. That's a sustained level that reflects genuine tightness in physical availability relative to demand for borrowing. When lease rates rise to that level, it tells you that entities with physical metal are demanding substantial compensation to lend it out, which in turn tells you they perceive risk either in getting the metal back or in sourcing replacement metal if the borrower defaults in a market with smooth, frictionless flows and ample refining capacity operating without administrative barriers. Lease rates don't behave this way. The fact that they are behaving this way suggests the administrative friction from Chinese export licensing is creating real constraints on physical metal movement. Now layer in the demand-side dynamics. Global silver demand in 2025 reached approximately 1.24 billion ounces. Total supply from all sources, mining, recycling, government sales, scrap, came in around 1.01 billion ounces. That's a deficit of over 230 million ounces, roughly equivalent to the entire annual production of Mexico, the world's largest silver mining jurisdiction. Deficits of this magnitude aren't sustainable indefinitely through inventory drawdowns alone. Either price has to rise enough to incentivize additional supply or demand destruction, or the deficit gets resolved through some other mechanism: rationing, substitution, or extended delivery timelines. In theory, higher prices should bring more supply to market relatively quickly. Silver is often a byproduct of base metal mining, so increased byproduct recovery could add supply without requiring new mines. Recycling rates could increase as scrap values rise. Exploration could accelerate in jurisdictions with favorable geology, but all of these responses take time, and several of them face constraints that aren't purely economic. China's export licensing requirement doesn't prevent Chinese refiners from processing more metal, but it does mean that any increase in Chinese refining output doesn't automatically translate into increased availability in Western markets. The metal might be produced, but if it doesn't receive export approval, it doesn't. Flow 2, where the demand deficit is most acute. This creates an asymmetric pressure structure. Demand is geographically distributed. Solar panel manufacturing happens globally. Electronics production spans multiple continents. Automotive and medical device supply chains are multinational, but the refining capacity that turns raw silver into usable forms is geographically concentrated, and the jurisdiction controlling the largest portion of that capacity has now interposed an administrative layer into the export process. The incentive for Chinese authorities isn't necessarily to restrict supply. Entirely doing so would damage relationships with industrial buyers and potentially accelerate efforts to build refining capacity elsewhere. The incentive is more subtle, to maintain leverage and optionality while allowing enough flow to prevent complete supply chain breakdown from a game theory perspective. This creates interesting dynamics. Western industrial buyers now face a choice: accept the uncertainty and potential delays associated with Chinese supply, or invest in building alternative refining capacity. Building that capacity takes years and requires substantial capital investment with no guarantee of long-term profitability if Chinese supply eventually returns to more predictable availability. But not building it means remaining dependent on a supply source that has demonstrated it can and will use administrative controls to manage export flows based on policy considerations that may not align with market demand. We're already seeing early indications of how different market participants are responding. Some industrial buyers are extending their physical inventory holdings, accepting the carrying costs as a form of supply chain insurance. Others are exploring long-term supply agreements with non-Chinese refiners, even at premium pricing, to reduce exposure to Chinese export approval timelines. Financial market participants are beginning to reevaluate the relationship between paper and physical positions, with some opting to hold physical metal directly. Rather than relying on derivative exposure, none of these responses are panic-driven. They're rational adaptations to a changed incentive environment. The financial derivative markets are where this tension becomes most visible, because that's where price discovery primarily occurs and where the assumption of frictionless physical delivery has historically been most embedded. COMEX operates on the assumption that market participants can arbitrage between paper and physical positions efficiently enough to keep prices aligned. That arbitrage depends on being able to source physical metal, transport it to approved warehouse locations, and have it certified for delivery against contracts within predictable timelines and costs. If any of those steps become subject to administrative delays or approvals whose timelines are uncertain, the arbitrage becomes riskier and less profitable as arbitrageurs pull back. The pricing discipline that kept paper markets tethered to physical reality weakens. This doesn't mean derivative markets become irrelevant. It means they start pricing different information. Instead of primarily reflecting the current balance of supply and demand for physical metal, they increasingly reflect the balance of speculative positioning, hedging demand, and expectations about future policy decisions by Chinese authorities. Physical markets, meanwhile, start pricing local availability and the specific logistics required to secure metal in particular locations. The result is price fragmentation, not a complete disconnect, but a persistent spread that reflects the friction in moving physical metal from where it is to where it's needed. Consider the implications for entities that are short silver in derivative markets. Being short silver traditionally meant you were comfortable either delivering physical metal if assigned or rolling your position forward if not assigned, knowing that physical metal was accessible enough that your risk was primarily price risk, not availability risk. Now, if you're short and there's increasing probability that counterparties will demand physical delivery because they don't trust their ability to source metal elsewhere, your risk profile changes. You either need to source physical metal in advance to cover potential delivery, which ties up capital and exposes you to the same supply chain uncertainties facing industrial buyers, or you need to close out your short position, which contributes to upward price pressure in derivative markets. We've seen some version of this dynamic play out in other commodity markets. Nickel experienced something similar in 2022 when Russian supply disruptions and short squeezes on the London Metal Exchange created conditions where short holders couldn't reliably source physical metal to deliver. The result was a market dislocation severe enough that the exchange suspended trading and eventually canceled trades. Silver markets aren't currently experiencing anything of that severity, but the underlying mechanism uncertainty about physical availability creating stress for derivative market participants who assumed they could always source metal if needed has parallels. The broader macroeconomic context matters here because silver's demand profile is increasingly driven by industrial applications rather than investment demand. Solar panel manufacturing accounts for a substantial and growing portion of global silver consumption. Each panel requires a certain amount of silver for the photovoltaic cells, and as solar deployment accelerates globally, driven by both climate policy and the improving economics of renewable energy, that industrial demand continues to grow. Electronics manufacturing, automotive applications, medical devices, all of these sectors consume silver in forms that don't easily lend themselves to substitution in the short term. You can't simply swap in a different material without redesigning products and recertifying manufacturing processes. This demand inelasticity creates leverage for supply-side disruptions. If industrial buyers can't easily reduce their consumption in response to higher prices or constrained availability, they have to compete more aggressively for available supply. That competition manifests as wider physical premiums, higher lease rates, and extended delivery timelines. It also creates incentives for hoarding behavior if you expect availability to tighten further. The rational move is to secure more inventory now rather than waiting. That hoarding behavior, in turn, amplifies the tightness it's responding to, creating a feedback loop that can persist until either new supply comes online or demand destruction occurs through economic slowdown or forced substitution. Chinese policymakers have multiple objectives they're balancing through these export controls. Domestic industrial policy favors ensuring adequate supply for Chinese manufacturers, particularly in strategic sectors like solar, electronics, and defense. Foreign policy considerations include maintaining leverage over trading partners and demonstrating China's importance in critical supply chains. Economic considerations include supporting domestic employment in refining and processing while managing inflation risks from commodity price spikes. These objectives don't always align perfectly, which means export approval rates likely vary based on changing assessments of these trade-offs rather than following a fixed policy rule. This policy flexibility creates additional uncertainty for Western market participants because it means the constraint isn't just about physical capacity or market economics, it's about decisions being made in Beijing based on considerations that aren't necessarily transparent or predictable to outsiders. You can analyze supply and demand fundamentals extensively, but if a significant portion of supply flows depend on administrative decisions whose criteria aren't fully disclosed, your analysis has inherent limitations. We're seeing this uncertainty manifest in forward curve pricing. The curve has steepened notably, meaning prices for delivery 12 or 24 months out are substantially higher than current spot prices. A steep forward curve typically reflects expectations that current tightness will persist or worsen rather than being quickly resolved. Market participants are essentially pricing in sustained premiums for future delivery because they're uncertain whether physical availability will improve meaningfully over that time frame. This isn't just speculation. Industrial buyers with genuine future needs are willing to pay these premiums to lock in supply, which suggests the pricing reflects real concern about future availability rather than purely financial positioning. The strategic question for various market participants becomes how to position given this uncertainty. Industrial buyers who need reliable silver supply face a choice between paying premiums for long-term contracts or accepting spot market exposure and potential delivery delays. Financial participants need to decide whether silver's current risk-reward profile justifies maintaining exposure given the reduced liquidity and increased physical delivery risk in derivative markets. Policymakers need to assess whether the strategic importance of domestic refining capacity justifies the subsidies and regulatory support required to build it. None of these decisions have obvious right answers because they depend on how Chinese export policies evolve, how quickly alternative capacity develops, and how resilient global supply chains prove to be under this new administrative framework. What we're witnessing is essentially the financialization of a commodity flow, being partially reversed. For decades, silver markets operated with the assumption that physical and paper positions were essentially fungible, that you could hold derivative exposure and convert it to physical metal efficiently if needed, or hold physical metal and sell it into liquid derivative markets to monetize your position. That fungibility kept pricing relatively tight and allowed markets to function efficiently with relatively modest physical inventories backing much larger derivative positions, as administrative controls create friction in that conversion process. The fungibility assumption breaks down, and markets have to adjust to a world where physical and paper positions are related but not truly interchangeable. This adjustment process is still unfolding. We're seeing it in widening physical premiums, rising lease rates, steepening forward curves, and declining registered inventories. We're seeing it in the strategic decisions industrial buyers are making about inventory levels and supply contracts. We're seeing it in policy initiatives aimed at building alternative processing capacity. But we haven't yet seen the full resolution of how markets will function in this new environment because the environment itself continues to evolve as participants respond to changing incentives. The historical precedent that comes closest is probably the rare earth markets in the early 2010s when China briefly restricted rare earth exports, creating price spikes and supply chain disruptions that eventually led to development of alternative sources and more careful supply chain management by Western manufacturers. But rare earths are different from silver in important ways. They're primarily industrial inputs without significant financial market involvement, and their applications are more specialized and concentrated in fewer industries. Silver's dual nature as both industrial input and financial asset means disruptions propagate through both industrial supply chains and financial markets in ways that rare earth disruptions didn't. The feedback loops between these two channels create complexity that's difficult to forecast precisely. Industrial supply tightness pushes physical premiums higher, which affects the economics of physical delivery against derivative contracts, which changes positioning in derivative markets, which affects price discovery, which influences industrial buying behavior, which affects physical availability. Each element influences the others in ways that can amplify movements in either direction depending on how expectations evolve. What seems clear is that the administrative layer China has added to silver export flows represents a structural change rather than a temporary disruption. The licensing requirement could theoretically be removed at any time, but having established the framework and demonstrated the leverage it provides, Chinese authorities are unlikely to give up that optionality without receiving something in return, whether that's diplomatic concessions, trade agreement terms, or strategic considerations in other domains. This means market participants need to adapt to an environment where this administrative friction is a persistent feature rather than a temporary anomaly. That adaptation will take different forms for different participants. Some will reduce their exposure to silver markets entirely if the complexity and uncertainty exceed their risk tolerance. Others will develop more sophisticated approaches to managing physical delivery risk and navigating Chinese export approval processes. Industrial buyers will likely continue the trend toward higher inventory holdings and diversified supply sources. Even though both strategies increase costs, financial markets will continue repricing to reflect the reduced fungibility between paper and physical positions. The outcome isn't predetermined. It depends on how quickly alternative refining capacity can be developed, how Chinese export approval rates evolve, how strong industrial demand growth remains, and how financial market participants adapt their strategies. What we can observe is that the incentive structure has shifted in ways that create persistent pressure toward higher prices, wider physical premiums, and reduced confidence in the efficiency of derivative markets as pricing mechanisms for the physical commodity. Understanding these dynamics doesn't require predicting exact price levels or specific timelines. It requires recognizing that when administrative controls are interposed into previously market-driven commodity flows, the resulting market structure functions differently in ways that persist until either the controls are removed or alternative supply chains are established. Neither of those resolutions appears imminent, which suggests the current environment of elevated uncertainty and structural tension in silver markets is likely to persist for some time.